Good evening, everyone. We'll be starting the session shortly. We'll just wait for two more minutes. Shall we start?
Yeah, Krishna, are you on the line? You good to start,
Yes.
Krishna?
Yeah.
Fantastic. Yeah, we're good to start. Yeah.
Sanjay, you want to give a brief introduction?
Yes. Okay. So good afternoon, everyone. I'm Sanjay Ibrahim from the DhanamOnline team. Welcome to the webinar on savings and investing organized by Dhanam Publications in association with Marcellus Investment Managers. This webinar has been organized as part of Dhanam's commitment to raising financial awareness in the state and help participants create long-term sustainable wealth. Today, we have with us Mr. Saurabh Mukherjea and Mr. Krishnan VR. Saurabh Mukherjea is the founder and chief investment officer of Marcellus Investment Managers. I'm sure he doesn't need much introduction as he's a very well-known portfolio manager and a celebrated author through his books, Coffee Can Investing and The Unusual Billionaires. Krishnan VR is the investment advisor at Marcellus Capital Partners, and he has over 10 years experience in equity and fixed income research, and he was previously with firms such as Morningstar, D. Shaw, and Goldman Sachs. So without further delay, I'll hand it over to the Marcellus team.
Thank you. Thank you very much. Thank you, Dhanam, for inviting Krishnan and myself to discuss long-term investing. I think there's some slides. I'll kick off on the slides and introduce what we're trying to do, and then Krishnan will take you into the core of how he builds advisory portfolios for our clients. Now, if you look at India over the last 10, 20, 30 years, it's evident that not just equities, but a variety of asset classes have made money, right? So if you look at gold, even gold over a 20-year horizon has compounded at 9%. This is in rupee terms, local currency terms. And even fixed deposits over the last 20 years, even fixed deposits have made a reasonably good return, 7.5%. And this is why what tends to happen is when you look at some of this, Indian households end up thinking that I really don't have to spend that much thought. Households end up thinking, I don't have to spend that much thought on where I should invest. Whatever I put money in, as long as I save enough money, I'm going to be all right. So whether it is gold or real estate or stock market or FDs, let me just save money and invest, and the future will be all right, right? But this is a very deceptive picture. This superficial picture, what you see on the slide, this is a very deceptive picture because it does not take inflation into account. We are a reasonably high inflation country, and this picture doesn't take inflation into account. What you see when you take inflation into account is very different. And if we go to the subsequent slide, what we are showing you in the subsequent slide is the returns from various asset classes after you've taken inflation into account. If you subtract inflation from the returns that various asset classes generate, there's only really one asset class in India which has made substantial amounts of money, which is the Nifty 50. So look on the right-hand side, the stock market, the blue line is really the only asset class which is significantly above 100. So if you started in 100 in a decade or so ago in 2013, you started with 100 rupees then. The stock market has brought you close to 300 over the last decade. Whereas, say, if you were unfortunate enough to be an investor in Indian gold, your 100 would have only become 142. So you'd be only half as rich had you done gold. Had you done fixed deposits, you would have gone to around 186, right? Residential real estate, the less said, the better. It's been a really difficult asset class to invest in over the last decade or so, right? So if you take inflation into account, after subtracting inflation, in investment parlance, we call that real returns. The stock market is the only source of significant real returns in the Indian market. Now, how does this play out for you? Let's move forward, Krishnan, one more slide. So how does this play out for you as you're a household, right? Let's take two types of household. Let's take Dhanam readers. Let's take hypothetical portfolio one. I call this spray and pray. A lot of households in our country do this. They say, let's just spray money. Quarter of it will have in real estate, a quarter in gold, bullion here, quarter in the stock market, Nifty 50, and a quarter in fixed deposits, term deposits. So if you look at the top right-hand pie chart, that's the spray and pray family. And if you look at that little table on the top right-hand, you'll see the spray and pray family barely makes any returns after taking inflation into account, right? The nominal returns don't look bad, around 8%. But after subtracting inflation, the spray and pray family is barely compounding the wealth at 2%. You're not going to get very far in life if your wealth is only compounding at 2%. On the other hand, the hypothetical portfolio to those Dhanam readers who are putting 80% of their wealth in the Nifty 50, right? The bottom right pie chart, that family's life is completely transformed, right? Their wealth is compounding not at 2% after inflation. Their wealth is compounding at around 13% pre-inflation and 6 to 7% after inflation, right? So the hypothetical portfolio one, spray and pray, 2% wealth compounding. Hypothetical portfolio two, 7% wealth compounding, almost 3.5x more. And these two numbers, the portfolio one versus portfolio two, these two numbers exemplify the difference between families who get rich after working hard and have families who don't. Portfolio one is families who don't get rich. Portfolio two is families who get rich. Now, how can you make yourself part of the hypothetical portfolio two family? What should you do to invest in the stock market, to invest significant chunks, 70, 80% of your wealth, right? So let's use some motivation. What we have done here in this slide is very simple. We have shown you what small sums of money saved over long periods of time at healthy rates of return can do. So let's start with the first column. Here, the assumption is you're saving 1 lakh at the age of, say, 25. Your compounding is 10%, right? Less than the stock market, but modest compounding, 10%. And you're letting it run for 30 years. You start at age 25, and 30 years later, your 1 lakh has become 17.5 lakh, right? Good outcome. 1 lakh has become 17.5 lakhs. That's a good outcome to have 10% compounding over 30 years. On the other hand, if you come to the right hand, the extreme right column of the table, and you look at the results there, right? If I look at Marcellus's portfolios, both PMS and advisory over the last several years, gross returns have been broadly in the vicinity of 19-20%. So just to round off and simplify to 20%, if I start with 1 lakh at age 20 and I let it run for 30 years, I don't get 17 lakhs. That's the first column. I don't get 66 lakhs. That's the second column. I get 2.4 crores, right? I stress again, folks, I start with 1 lakh. I start with 1 lakh at age 25. I let it run for 30 years at a 20% compounded rate. And by the time I'm ready for retirement in my late 50s, I have the best part of 2.5 crores in my bank account, right? That's the power of long-term compounding. The only way you can get this sort of compounding is in high-quality Indian stocks. Real estate, fixed deposits, gold is not going to do it for you. To really transform your life, you need patient, high-quality investing over long periods of time. Now, this is at the at the stock specific level. Let's look at it as at a portfolio level, right? If you combine various stocks in a portfolio, what happens? It gets even more powerful. So in this slide, we've tried to exemplify this, explain this using a simple 2-stock portfolio. So suppose you put 100 rupees in stock A and 100 rupees in stock B, right? You do it yourself, you give it to a fund manager, you hire an advisor like Krishnan. I'll leave it to you to decide how you do it. But you put 100 rupees in stock A and 100 rupees in stock B. Now, unfortunately, the stock B call is wrong, and overnight that money goes to zero, right? So in stock B, you lose everything you've invested. Stock A works out. On stock A, you get 5x in 5 years. Your 100 becomes 500, right? Very doable. If you have a high quality stock selection algo, you'll be able to get 1 out of 2 right. Your 100 becomes 500. Over those 5 years, what's your compounded rate of return? You put in 200 on day 0, 5 years hence you got 500. Your compounded rate of return is 20%. Even though half of your portfolio got blown out of the water, half the portfolio, 50% of the portfolio was a write-off. Even then, even though you got half the portfolio right, your compounded rate of return is 20%. And what did we discuss on the preceding slide? On the preceding slide, we discussed that if at age 25, you put 1 lakh in, getting 20% returns over 50 years will take you to 2.4 crores. In this slide, we're showing you, even if you get half your portfolio wrong, you can still end up with a 20% return, provided you let your money compound over 5 years. So how do you build these portfolios that compound your wealth at this sort of quantum, right? I'll request my colleague Krishnan, who's our investment advisor, to take over and take you through that. Over to you, Krishnan.
Thank you, Saurabh. I'll just quickly touch upon a behavioral aspect of investing, which MeritorQ, which is our product, right, which is available on small case, which tries to address this more directly, right? So if you ask anyone what's the formula to make money in any asset class, it's very easy. They'll tell you buy low and sell high, which is you buy something at a low price and you sell it at a higher price, right? So while common sense suggests that this should be the pursuit of every investor who is participating in markets, what generally we see is generally the opposite happens, right? And this is due to a combination of, again, emotional biases of investors, because again, all of us are human beings. We are prone to biases, no matter how hard we try to control them. And also there's an external noise, right? So if you take an example, right, one way this manifests itself is this fear of missing out, what is called as FOMO, right, of investing in an asset or in a company, especially when everyone around you, your family, friends, TV channels, WhatsApp forwards, everyone is talking about that, but that next hot company or that hot stock to invest in. And this causes investors to rush into buying that company or that asset, even if it is overvalued, right, because they fear on missing out on the future price increases. So the advice is to buy low, sell high, but we incur losses by actually doing the reverse, right? Yet another example of this bias is selectively over-focusing, for example, on certain parameters. For example, what you usually see is investors focus on the company's business prospects, when the markets are down, right? Because they're worried about whether their investments will make money or not, right? On the converse, they would generally they neglect the corporate governance aspects, when the markets are doing really well, right? When actually, if you think about it, both these factors are important, no matter what the market conditions are, right? So this is where MeritorQ has an advantage, because MeritorQ again is completely a rules-based portfolio. So I'll come to the rules in the subsequent slides. So we follow the rules per the checklist, and because we follow the rules, it's a completely disciplined approach, and that way you can reduce your bias and also cut out noise. Okay, now if I have to sum up the investment objective of MeritorQ, it can be summarized as simply as buying good clean companies at reasonable prices. Now, good or quality companies can be defined in different ways, but in MeritorQ, we define it again basis companies which are efficient, profitable, i.e. they have high returns on capital. They don't take a lot of loans. Essentially, they have a strong balance sheet, right? And also companies which are clean in the sense that they don't cheat their shareholders, and they're clean on corporate governance. So that's our criteria of identifying good companies in MeritorQ, right? But ideally, when we buy these good companies, we want to buy them at prices below their fair value. In MeritorQ, we define fair value again basis their free cash flow. So we compare the price at which we are buying versus the free cash flow generation of the company. If you think about free cash flow, again, simply to put it, it's the cash which is remaining in the pocket of the company after after it has paid all its operating and capital investments, operating expenses and capital investments. So if you just take an example, if you have two companies again trading at the same price, and company A has a free cash flow per share of say 20 rupees, right? And company B, which has a free cash flow per share of 80 rupees. So in MeritorQ, we prefer company B over company A, simply because for every rupee you're paying for for buying that share of that company is generating more free cash flows. So good undervalued companies again pick regularly while avoiding biases and external noise, which we discussed in the previous slide. The next slide, let's see what exactly these rules we are talking about in MeritorQ. So again, one way to think about these rules in MeritorQ is you can think of it as a simple checklist, right? A simple checklist of good investment rules to reduce your chance of making bad investment decisions, right? I'm sure all of us would have used checklists at some point in our lives, right? Now checklists in fact have been found useful not just again the way we understand it, but it's also useful in many other domains in which the complexity is much higher, like for example in aviation or surgery, right? For example, checklists are widely used by pilots nowadays for flying civilian airplanes like Boeing 747 or Airbus 320, because these checklists have been found very effective in reducing mistakes and making sure that pilots perform all the steps of flying the airplanes precisely and unfailingly, right? So just as your daily checklist, which we are used to, as well as checklists, which are used in aviation or surgery, an investment checklist, which we are employing in MeritorQ, basically makes sure that we are applying all the checks, for making our investments consistently and without exceptions. Right now, coming to the MeritorQ checklist. So the very first step is we start with the top 500 companies in India, the large, mid, and small cap companies. From this, again, we remove 200 odd companies, per our forensic screen, right? What we call as a forensic screen. Essentially, we are removing companies, which are not showing their which are not presenting their accounting in a fair manner, right? Essentially, the clean companies which I talked about in the previous slide. So we are only keeping the clean companies and we are removing the frauds and the companies with corporate governance issues, right? So, and on the remaining 300, we again remove companies which take a lot of loans from banks, i.e. which are highly levered. And again, high debt is never a good thing. And I'm sure a lot of people who are on this call, they will agree that again there are the Indian corporate landscape is littered with examples where companies have taken a lot of debt and they have done well in the short run, but over long run they have defaulted or they have gone bankrupt with too much debt, right? So we remove companies which have taken too much loans, too much debt. Finally, we also remove very cyclical businesses, right? So this would be an oil and gas company or a steel company, where the revenue of the company is again determined by the commodity, right? For example, the oil prices or the steel prices, over which the company itself doesn't have any control. But the problem with including very cyclical companies in the portfolios is again you're not sure even during a 1-year period where the revenues or the profit of that company might end up, right? When you're holding this company in the portfolio. So those are the 3 steps, the 3 screening steps which we employ in MeritorQ. And from the 500 odd companies we started out with, we removed roughly around 400 to 420 companies. We're left with around 80 to 100 companies where we on this 80 to 100 companies we select companies which are both profitable as well as undervalued, right? Profitable again basis the criteria I talked about in the previous slide, and undervaluations again we are looking at on the free cash flow. So company again which are undervalued with respect to the free cash flow. The final allocations in the portfolio are again decided basis the extent of the undervaluation. So more undervalued the company is with respect to its free cash flow, the higher allocation it gets in the final portfolio. So those are the 5 steps in the MeritorQ checklist. We repeat the steps in this checklist to create the portfolio every once in 6 months, right? And this is what we call as rebalancing. So coming to rebalancing, again, we, it's this process of going through this checklist twice in a year, as of the first trading date of April and October, is what is rebalancing. Rebalancing basically allows you to do two things: pick up undervalued stocks regularly. So, for example, if companies' stock prices have run up, what would happen is, company would no longer seen as undervalued, per our measure of undervaluation, which is, we are comparing the price versus the free cash flow. And also its weightage or its allocation in the portfolio will also be slashed, because remember, we are also allocating in the portfolio. The final allocations are also basis the extent of the undervaluation. So rebalancing allows you to pick up undervalued stocks regularly and or reduce your allocation towards those whose prices have appreciated. And the second advantage of rebalancing, it allows you to reflect any change in the fundamentals. When we say fundamentals, say for example, a company was passing your forensic screen, or which was screening as clean, say 1 year back, but it's no longer doing so now in the current rebalancing basis, the updated financials of the company. So, what would happen is we would remove that company from the portfolio, right? So, and what we have seen is, again, because rebalancing necessarily involves churn, what we have seen is roughly this adds introduces a churn of around 50%, roughly annualized, when we have tested these rules, in history over a period of 16 years. And this is the churn you can also expect going forward. So again, just to summarize again what we discussed, if you apply these these rules, checklist which I talked about, the 5 steps in the checklist, right? What we have tried to show in the funnel chart on this left is, again, we have just broken it down in terms of the contribution from each of the steps in this checklist to the back-tested returns, right? When I say back-tested return, you just go back in history and you use the data as of that point in time, and you simulate this, this rules, and you rebalance this portfolio twice in the year. So exactly what you would have, any investor would have experienced if they had invested in this portfolio, right? And we do this over a period of 16 years, from 2006 to September 2022. And these are the results, again, what you see on the left, which you have broken down in terms of individual steps. What you see immediately is, the very first step, where you're looking at the equal weighted, the 500 stock universe, from where we again apply all our rules, which is our starting point. That is roughly 8%. So that, that generates a return of 8%, on a 3-year rolling basis, if you average it over a period of 16 years. And then as soon as you apply, the forensic screen, right, where we are getting rid of companies, again, which are earnings manipulators in some sense, that itself adds around 5 percentage points, roughly 5 percentage points addition to the previous step. And then each of the subsequent steps, again, I don't need to go through it in detail, but again, each of the subsequent steps, you can also see that it's adding value in terms of the overall return. So you're starting from the 8%, you roughly get to a 22% annualized on a 3-year rolling returns for the final portfolio after the all the 5 steps in the checklist which I talked about, right? The right chart, again, it's a basically a wealth chart. So if you have someone had invested 10,000 rupees in MeritorQ in July 2006, how it would have looked like, over a how much that would have earned over a period of 16 years. So roughly 20 times, your wealth would have compounded versus 7 times in Nifty 500, which is the benchmark. So, so again, so that's what again we are doing in MeritorQ, and it's a very simple, transparent approach. Again, it's, whatever you're seeing on this slide is whatever exactly what we have done. And like I said, it's a a very rules-based and a very disciplined approach for you to compound your wealth. But please keep in mind that this is equity. So whoever is again, like Saurabh said, if you're thinking of investing in equities, you would at least have a 3 to 5 year horizon in mind, because that's a minimum time period which you need to ride out the volatility in equities. So again, that's the kind of horizon which you should also keep in mind before investing in this product. That's all from me.
So we'll hand it back to the Dhanam team. If you guys have any questions, be happy to take them.
So to the participants, if you have any questions, please raise your hand and you can ask, or you can type it in the Q&A section. We will read it out, and then your questions will be answered. Sanjay, meanwhile, do you want to start with the question?
You mentioned that this was available on small case. So could you explain what small case was for everyone?
So small case is like a platform where you can buy a basket of stocks, right? Essentially portfolios. And these are basically, again, these portfolios are advised by the research analyst or, investment advisors like myself. And essentially all these portfolios are created basis the strategy being followed by that particular investment advisor or the analyst. And again, this is listed on their platform. And once you go and subscribe, so you need to pay a fees, for example. So what would happen is, and other requirement is you need to have a brokerage account, right? So if you have a brokerage account and you go and subscribe to a particular portfolio on small case, you can buy the entire portfolio of stocks, which has been recommended by the investment advisor or the research analyst. And essentially that stock, the set of stocks then are bought into your demat account, right? So, whoever, if you're subscribing, whoever is the investor, they have full control over, their investments, because again, the stocks are not, you're not going to give us money unlike a mutual fund. So, here the, whatever investments you're making will still reside in your demat account.
So we've received 2 questions. So one is hi from Mr. Praveen. Hi, for someone who is new to this type of investment, where do we start? That's his question. Somebody wants to take it?
Krishna, do you want to take it?
Sure. So when you say this type of investment in equities or, again, in MeritorQ or
equities, because nothing specific has been mentioned. So let's answer equities.
Yeah. So for someone, if this is your very first investment in equities, yes, I mean, you can take the passive route, you can take the mutual fund route, but again, for going back to the example which Saurabh said, or you can invest, in MeritorQ. But going back to the example Saurabh said, please don't start investing yourself, right? By investing yourself in, especially a narrow bunch of stocks, or creating a very or investing in a very small set of stocks, like 5 or 6 stocks, just because you heard some tips about it, or you think those stocks will do well for whatever reason, because that's generally what you see is the reason investors lose money, because they don't know when to buy or what to buy. So the right way to start investing is to start with a trusted, or either a trusted mutual fund, or any other advisor you trust, or you can obviously invest through our product which is listed on small case. But yeah, I mean, go through a seasoned investment professional.
Thank you. I think the next question is, wouldn't rebalancing once in 6 months be too infrequent? There could be so many dynamics that could have happened during 6 months, which we would miss out. So basically the question is, 6 months, isn't it too infrequent?
Yeah. So look, we have we tried different frequencies, right? We have tried rebalancing this. When I say tried, we tested rebalancing it, monthly, quarterly, at even shorter frequencies. But what we found is, again, a 6-month rebalance is again gives you the ideal kind of the trade-off between too much churn. So if you rebalance often, your churn increases, right? And when if your churn increases, your transaction cost, i.e. your brokerage, which you have to pay to your your broker, and also other taxes, etc., they increase, right? So churn is never a good thing. So what we found is rebalancing every 6 months allows you to strike this right balance between incurring too much churn, and at the same time you optimize your risk-adjusted return. right? So to answer more specifically to that, the listener's question, this entire set of returns which you see on this slide, again, which is broken up in this funnel chart, again, we have rebalanced this every 6 months, right? If, for example, there were such cases, right? If you think about it, negative developments of the company in between, the two rebalance states, those are already reflected in the returns which you see. So if again, this was such a big problem, you would have already seen this reflected in the returns. And obviously, again, going back, the biggest reason why you should not, worry about something like this is our screening steps in the first place, right? So the 3 screening steps which we have, where we are removing companies which are, frauds or, manipulating their earnings, which are also taking too much loans, and also companies which are cyclical. If you just remove these 3, what we have found is that itself, right, the screen universe itself makes sure that there are, you basically minimize the chances of, investing in companies which would see huge negative development between 2 rebalance states, right? So the screening steps themselves are, you can say almost like an insurance, right, which makes sure that, you will not run into any issues, even if you don't do anything with the portfolio for a period of 6 months.
And folks, take this very seriously. This point Krishna is making: the less you trade, the more money you will make. There's tons of evidence. So 6 months ago, SEBI published a study that 90% of traders in India make more money. Around a couple of months ago, the Zerodha founder, Nikhil Kamath, he tweeted 99% of their clients make more money. I've shown in my books, in Coffee Can Investing, for example, I've shown that if you do nothing for 12 months and let your portfolios run for long periods of time, you'll compound at a healthy rate. Krishnan is showing you the same thing. So this notion that you have to do something once every 6 months, I think that's as much as you need to do. If you're fiddling with your portfolio every week, every month, you've had it, you're never going to get anywhere in any country. It's not a India specific thing. People who trade the least make the most money.
So we have the next question from Mr. Eldos. So his question is, what are the risks for India long-term story?
The risks for India long-term story is not something necessarily you need to lose too much sleep about. The sleep that you should lose is if you don't invest in equities, you're guaranteed to be wiped out in India, because cost of living for everybody on this call, cost of living for us is growing at least 5-6%. To earn 5-6% returns after tax, we need to earn 8-9% returns before tax. And if we don't have the bulk of our wealth in an equity portfolio, we're not going to get 8-9%. Banks are not going to give you FD rates of 8-9%. Gold is not going to compound for you meaningfully north of that. Neither will real estate compound for you north of that. So if you want to protect yourself from wealth depletion in India, people on this call, we have no choice. We have to invest in equities. So turn the question on its head, sir. The risk is not the Indian economy will go down, or there'll be some election, some dramatic election result that will kick in next year or the year after, or that there will be Israel-Hamas war, right? Those sorts of ways of thinking are very destructive. Think of the default. The default is most people in India, RBI data says 95% of household wealth in India is in physical assets, which is real estate and gold. Right? I have seen millions of Indian families who do this. This RBI data, 95% of wealth in physical assets. Physical assets do not create wealth. Vast majority of Indians spend their whole life working. They don't create wealth. Inflation depletes their wealth at the rate of 5-6% a year. And the only way to fight that battle is by allocating the vast majority of your assets to the stock market. Do so in a responsible manner. As we discussed, trade less, allocate more to equities, and worry less about macro risks and political risks and global warming and climate change and so on. That's not going to take you very far in life. The biggest risk everybody on this call faces is the guarantee that inflation will wipe out your wealth every single day that you wake up and go to work.
Thank you. We have a question from Mr. Basil Baby. This question is, how is this different from mutual funds?
I can take that. So, like I said, the key difference is in a mutual fund, you would transfer money to that fund, right? So you'll have to subscribe to the mutual fund, and you need to actually transfer how much whatever you're investing, that money you need to transfer to the mutual fund, and then the mutual fund will again buy the stocks on in your account, and you will be given the units of the mutual fund, issue the units of the mutual. Here it's not like that. Essentially, you need to have a demat account where once you go and subscribe to this for example MeritorQ on small case, you will be shown this list of stocks or this basket of stocks per using these the rules which we talked about, and you need to then execute this all these purchases, right? And once you execute the purchases through small case, the stocks will be bought into your demat account, right? So they will be sitting in your demat account. So in that way, money is not going anywhere else. So either it will not be transferred to us also. So whatever investment you're making, it will reside in your demat account itself.
So we have another question from Mr. Sanjeev. Can you explain the charges? Is it a fixed fee model or variable?
So we have both. So the details. Alok.
Yeah, I can take that.
Alok, would you like to show? Go ahead, please. Go ahead.
So we have two options the client can choose from. So one is either they can give us 2,500 per quarter, irrespective of the amount they invest in, or the other one is they can choose a AUA based fees, which is 2.25% per annum, but charged on monthly basis on the daily average value of the portfolio.
All right, thank you. So the next question is from Mr. Prem Paul. Can you please suggest small, mid, or large cap, which will be the best for mutual funds if I start now per day?
So you want us to suggest this asset class? So that's a bad idea. Why should we do that? My suggestion to you will be invest in a high quality Indian portfolio with stocks spanning all caps. Don't try to say large cap, today large cap, tomorrow small cap, day after mid cap. I know this sort of nonsense is propagated publicly that at the moment, some wise person will say at the moment small cap looks better than at the moment large cap looks better than small cap. 5 months later, some other tune is being sung. That's largely done to help you part with your wealth by making you churn from large cap to small cap to large cap. Brokers help you part from your hard-earned money. Build a portfolio of high quality Indian stocks. Let it run for years on end. And don't worry about whether large cap is in fashion today or small cap is in fashion, IT is in fashion today or BFSI. That's not a way to create wealth. Create a portfolio of high quality stocks. Krishnan is saying he's here to do it for you. He'll give you MeritorQ, as Krishnan said, as a portfolio of 30 to 45 stocks. These are stocks in your portfolio, in your demat account. That's your portfolio. All he does is advises you every 6 months on how to rebalance that portfolio and what, if anything, to sell. And take that measured approach over extended periods of time, rather than being subject to the sort of usual whims and fancies and fads and fashions of the Indian market, most of which are generated to help you guys part with your hard-earned money.
Thank you. We have another question from Mr. Joby. Is it possible to book in between if I have received a satisfied profit?
It is possible, but not advisable. If you think, sir, that you'll make a profit and then you book it, again, you're going to be back to daily wealth destruction. Remember, everybody on this call, and myself included, every single day that I leave the bulk of my wealth outside the stock market, that day, with guarantee, my wealth is destroyed to the tune of 6%. That's roughly inflation for people on this call, for people like you and me, right? I'm doing this call with you on a foreign phone. I'm sure all of you are using a foreign phone or foreign laptops. The bulk of the components in your car are imported. When you watch OTT programs tonight, you watch it on a foreign TV. The OTT will also be imported. The content will also be imported. So your and my cost of living is rising every day at 6%. If you don't have the bulk of your wealth in the stock market, your wealth is depleting every day. The day you book profit, the day you say, "Arey, chad gaya, it's made money, let me book profit," that day you're back to wealth getting destroyed. And typically, those who sell out at the top, no, they're not able to get in. Right? Neither you nor I, nor anybody I've met can time the market to say, "I will get in low once profit is done, I'll book profit." You can book it. Nobody's going to stop you. Krishna's not going to call you up. Neither will I call you up to stop you from booking profit. But that's not an advisable thing to do. This booking profit business is something which I think has to be avoided.
Thank you. So we have a question from Mr. Sanjeev again. What is the reason for higher number of stocks in this model versus the PMS? Is it because it's quantitative versus qualitative?
I think Sanjeev is a bright guy. Krishna, do you want to elaborate on the point of view that Mr. Sanjeev's already given us?
Yes, yes, it is. That's partly true. And remember that again, the one of the reasons again we are choosing these stocks is again it's not it's not that we are targeting 15 or 30 stocks or something. It's it's a result of all the steps we have taken, right? And like I said, after the screening we are left with 80 to 100 stocks. So the opportunity set from where we are selecting, that itself, if that has to be meaningful, that means that the portfolio has to be at least less than 40 stocks. Now, why it's not too concentrated, the listener is exactly right, because this is a quantitative portfolio. And look, the other reason is also we don't want investors here to incur large drawdowns, right? Our PMS portfolios are more concentrated, but that also means the drawdowns can be higher, right? Versus a larger portfolio. So again, here at least the one of the reasons we have a larger portfolio is that the drawdowns, what we have seen is the risk of drawdowns at least is reduced. With this 30 to 45 stocks. And like I said, right, we don't target a particular number of stocks. What I can tell you is the number of stocks in MeritorQ would vary between 30 to 45. It will definitely not go down below 30. By the same time, it should not go down or go beyond 45 either, right? That's what we have seen, at least, when we have tested it. But yeah, I mean, so overall, I think the reason why we have restricted it to at least 30 is because we don't want the investors to incur excessive drawdowns.
Thank you. We have a question from Mr. Felix John to Mr. Saurabh. I've heard of your CCP portfolio. As I'm not rich to invest 50 lakhs in PMS, is it advisable to make a subset of your coffee can portfolio with few stocks from it?
Right. So first of all, I think for everybody on this call, it's advisable to build a equity portfolio. As we discussed, it's the only asset class in India which will help you and me consistently beat inflation. Secondly, as I've explained in the book Coffee Can Investing, buying a bunch of high quality stocks and letting them run for long periods of time has proved to be an effective way to make money. Right now, both in the book and in our webinars, we give the names of all our portfolios, not just CCP. We give the names of LCP, Kings of Capital. We give away the names, right? Will knowing the names help you? No, they won't. Why won't knowing the names help you? So to give you an example, last year, calendar year 2022, Divi's Lab halved in share price, right? Divi's Lab halved in share price. This year in Jan 2023, Marcellus quadrupled its position in Divi's Lab, right? So everybody knows, the world knew we held Divi's Lab. Obviously, when it halved, a lot of people had a chuckle. What people don't realize is that when we double, triple, quadruple in this case, when we quadruple positions, that's when we really are able to deliver value for our clients. Divi's is a high-class company, and we quadrupled the position through Jan. Since the end of Jan, the stock is up by around a third. Similarly, in the first 4 months of 2020, Bajaj Finance held 65%, right? And everybody sort of had a chuckle saying Marcellus loaded up on Bajaj Finance. It was one of our largest positions actually. And it fell 65% as COVID hit the world. In May 2020, we tripled our position in Bajaj Finance. Now, you won't have the time, the the bandwidth required to do this sort of investing, where when stocks come off, you rapidly increase your position sizing in that name. That's why we have someone like Krishnan building the portfolio for you, giving you the names of the stocks, giving you the position sizing. So as Krishnan explained, valuation is one of the four critical pillars on which MeritorQ stands. When the stocks come off, every 6 months, Krishnan intervenes and tells you increase the position size of XYZ stock. It's a good company, it's come off radically, vice versa as well. Krishnan intervenes and tells you reduce the weight of XYZ stock. It's a good stock, but it's gone up sharply. He does this in an advisory capacity, which means you can ignore him, but at least he's there as your voice of sanity. So in a PMS, you give us your money, we look after it for you. If you can't afford that, for the reasons you mentioned, if you can't afford that, bring an investment advisor into the picture. The investment advisor will give you a portfolio, will tell you every so often what to buy more, what to sell, and what to bring into the portfolio. It's up to you to listen to the advice. It's just like when we go to the doctor can't force us to take the medicine. It's incumbent on us. Sensible people listen to the doctor. Sensible people listen to their investment advisor.
Thank you. So the next question is, are there any tax benefits doing it through MeritorQ versus mutual fund investment?
Mutual funds are taxed. So the capital gains tax on mutual fund, 15% short-term, 10% long-term. Equity investing, whether you do it in PMS or MeritorQ, same tax rate. So no differences. For obvious reasons, the government is not going to let you create. Let me create, let you create, let anybody create the tax advantage product. So tax regimes are identical, whether you buy and sell mutual funds or you buy and sell stocks, whether you do it on your own, whether you do it using an investment advisor.
So there were two other questions on, one was about also, what is your opinion about commercial real estate in stocks? I believe you had answered that earlier. So do you want to repeat, or we'll just...
Same point of view. Commercial real estate, the yields you'll get in the big cities of our country to be 6-7%. Again, inflation for you is 5-6% pre-tax. If you want to take 5-6% after tax. So to beat inflation, you need 8-9%. It's unlikely commercial real estate will help you beat inflation.
So there was also a question about how any major geopolitical risks can impact Indian stock market returns. But that I believe you had already...
Yeah. So this is really, again, I stress again, folks, this is what lots of people do. This is real night. This is how people direct their lives, right? What will climate change do to India? What will China do to India? What will geopolitical risk do to India? What will happen in the election? This, that, the other. You can spend your whole life thinking about this. The only guarantee I give all of you is inflation will destroy your wealth if you don't invest heavily in the stock market. There are no other guarantees in life other than the fact that inflation will destroy your wealth every single day when you leave your portfolio outside the stock market.
Thank you. There was a question about how the index funds are performing. I think probably a comparison.
Index funds are performing in line with the index, right? They're meant to replicate the index. And the reason you and I put in effort in investing in a portfolio of handful of stocks. So BSE 500 has 500 stocks literally in it. A BSE 500 index fund literally, naturally should and will copy the BSE 500 index. A concentrated portfolio, whether it is CCP or Krishnan's MeritorQ, will have a subset. It's a curated subset. It's a high quality subset and should be beating the index. As you'd expect, something like this. If you see the chart in front of you that Krishnan's left on the screen, it beats the index by a country mile. In fact, he's shown that 20x returns for the strategy versus 7x returns for the index. In this case, the index is the Nifty 500, which is similar to the BSE 500. And that's to be expected, right? Krishnan's strategy is taking the blue bit. Krishnan's taking a curated subset, a high quality subset. He's taking the best students in the class. The index is the class of 500 students. The index is the red, 7x in 20 years, whereas Krishnan's portfolio is 20x in 20 years.
Thank you. We have a question by Mr. Joby. Charges will be applicable if the portfolio, whether it will be applicable if the portfolio is in loss.
Yes, I think the charges will be applicable. In our PMSs, we have performance fees. MeritorQ is an advisory portfolio. You can disobey us. You can not listen to us. Therefore, MeritorQ charges are fixed. You're free to sack us at any moment. At any moment, you can log online and say, I don't want to pay Marcellus anymore. So that's that freedom you have. There is no lock-in. You can get rid of us whenever you like. And obviously, the day you get rid of us, you don't have to pay us any fees thereafter.
Yeah, but on the AUA linked fee, which Alok mentioned, in that if the for example, if the investor is incurring losses, then automatically you pay less fees, right? Because your invested amount will go down, right? And it's like in our case, it's 2.25% of the invested amount. So by that logic, at least the fee you pay us, if we are incurring losses, that should go down.
So next question is, are you following growth strategy? Why growth stocks underperformed value stocks in last 2 years?
We don't follow any growth strategy, value strategy. As Krishnan explained, and I'll summarize. First, we look for clean companies. Screen 1, clean. Screen 2, low debt equity. People who haven't leveraged the company, who haven't borrowed a lot of money from the bank, right? So first screen, clean people. Second screen, sensible promoters who haven't leveraged, borrowed a lot of money. Third screen, profitable, high return on capital, highly profitable. Fourth screen, cheap, not just clean and profitable company, but available cheap. That's all we do. We don't wake up in the morning and say growth value. That's another kind of charade. That's practice to confuse people.
So the next question is, if a stock has run up a lot in a short period, what should we do? Company fundamentals remain strong, but valuations are no more cheap. Should we book profit and move on?
So, Krishnan, over to you for that.
Yeah. So, look, I mean, you should, wait, right? And also, again, like I said, right? I mean, if you try to do this often, what this often results is you end up interfering with the portfolio, regularly, which means obviously you're churning a lot, right? Which is never a good thing. And it's not wrong to use valuation to, enter and exit stocks, right? Like the way we are doing in MeritorQ, but you have to do it in a disciplined way, right? Whatever works for you, right? Again, it could be simple rule of thumbs or, some heuristic that you're following, but practice it in a systematic way, and make sure that your churn is under control, right? You're not interfering, every now and then, just basis short-term movements. Rather, just do it maybe once in a year if you want to, or maybe even less often than that, because as long as you're buying good, high-quality companies, and I think that's a central message, I think what Saurabh is emphasizing and what I've also talked about, as long as you're buying good, high-quality companies, you ideally should not be interfering or have the need to interfere, right, in the portfolio, because these are companies which, again, have passed all those, screens or, our checks. And even if you keep them in the portfolio, for like, 4 or 5 years without interfering, in fact, you should earn as good returns than, for example, frequently churning basis valuation, right? So the message again being that good quality companies, and whatever approach you take, whether it's valuation, whatnot, please follow a disciplined, systematic approach to that.
Thank you. There was a question from Eldos. How do you assess the quality or integrity of the company managements?
Krishnan, you want to take that?
Right. So in case of MeritorQ, at least, we have a check in the end where we are, again, we manually remove companies where we think the promoters, again, are stealing money, or, there is some corporate governance issue at, the promoter level, which is very hard to quantify, right? So in those cases, what we do is we manually remove these companies and redistribute the the weightages,
I think this is perhaps worth explaining the basic forensic screen. I don't think he's asking that. He just wants to know what's the basic forensic screen, the core forensic engine that you use.
Sure. So the forensic screen is essentially, again, it uses a set of ratios, financial ratios, In case of non-financials, we have we use a set of 11 ratios. In case of financial company, we use around 10 ratios, right? And so one example of a ratio which we use is we look at the cash flow from operations which is generated by the company, and we compare that with the earnings of the company, right? Essentially, the profit after taxes of the company. So if a company is consistently generating very low cash flow from operations with compared to its profit after tax, essentially that means is a lot of the profit after tax, the earnings, essentially it is an accounting construct, right? Essentially, which is in the hands of the accountants or the accounting department of the company, that is either inflated or company is not able to translate a lot of that earnings into actual cash, right? For us, cash is king, right? And again, cash is the reality. So again, companies which are able to translate or convert most of their earnings, reported earnings, to cash, they get a higher score in the forensic in our forensic ranking, right? So that's one of the ratios, remember, among the 11 ratios I talked about. And like this, we have 10 more ratios. Again, we use different information from cash flow the cash flow statement, the balance sheet, as well as the profit and loss account, right? And we combine all this to again look at and come up with our forensic score. And like I said, we use this to then remove the 200 odd companies, the bottom 200 companies which score the lowest on this on the forensics, because what we have seen is these are generally the companies which are manipulating their accounts, right? Essentially, like in the example I gave you, essentially this would be a company whose CFO to whose cash conversion is very weak. Essentially, what that means, the company is either under recognizing its costs, or it is over recognizing its revenues, right? So in that case, we just avoid investing in these companies.
So we have a question from Mr. Basil Baby on what are the ways to subscribe. It costs 2,950 through small case. Are you planning to offer any discounts to the webinar participants? Maybe we can take this after two more other questions. So there was a question, anonymous attendee, for a beginner, which is better and of less risk, mutual funds or equity?
I think mutual funds can be debt mutual funds, they can be commodity mutual funds, they can be equity mutual funds. So I think it's a little bit of you're not comparing apples with apples here. If you don't want to build your own equity portfolio, right? You're a busy person, you've got plenty to do in your life, then buy a high quality mutual fund or buy an index mutual fund. Right? If you don't want to have your equity portfolio and you don't want to take the trouble of opening a demat account and having your own portfolio, then buy an equity mutual fund. The main message we've been trying to give over the last hour and a bit is have the bulk of your assets in equities, because otherwise inflation will eat into your wealth. In the context of equities, build a good portfolio. If you don't have the resources or the time to do so, then buy a good mutual fund and you'll be done.
So there's a question from Mr. Joby. I'm not sure how I get it right, but rebalance needs additional money to invest against profit booking.
No, it doesn't. Rebalance doesn't need additional money.
So there was okay. Oh, there's another question. Difference between PMS versus mutual funds versus small case.
So PMS is you hire a fund manager to manage money in your demat account, right? So PMS, you open your demat account, the fund manager manages your money in your demat account. Mutual fund, you give your money to somebody else. They take your money and they put it in the common pot with other people. You have no control on your money once you've given it to this third party mutual fund manager, right? And small case, or the advisory construct we've outlined in the last hour and a bit, is you keep your money in your demat account, you look after it yourself. An advisor like Krishnan gives you the stocks to buy and the weightages which to buy. So 3 different formats. Mutual fund, you have the least amount of control. You're giving your money to a mutual fund house. They will pool your money with other people, millions of other people, and they'll pool your money in a pot over which you have no control. You've given your money to the mutual fund house. They give you units in that pot. If you don't like what they're doing, you can sell the units and get your money back. In PMS, the fund manager manages money in your demat account. Your demat account will be separate from other people's. Your demat account is specific to you. The portfolio is specific to you. In the small case advisory construct, you keep your money in your demat account. You're the manager of the money. Someone like Krishnan is the advisor. He advises you on what stocks to buy and sell and in what quantities.
Thank you. So there was a very interesting question I kept for the end before we go to Basil babies. The question was how to escape our government higher taxes.
So to be fair, actually, taxes on equities are not particularly high in India, especially if you're a patient investor. So 10% long-term capital gains pales into insignificance, I would submit to you, compared to the income tax rates that most of us pay, right? So and remember, on unlisted equities, long-term capital gains is 20%. So listed equities actually have a very benign tax rate. If you are a patient investor, more than 1 year, then long-term capital gains tax rate of 10% is very benign. The stock market ecosystem in India is well regulated, highly sophisticated. If you keep your wits about yourself, the cost of trading is low, taxes are low. And again, compared to gold, compared to real estate, compared to unlisted equity, unlisted stocks, this is venture capital investing, equities is the most tax-friendly asset class. Equities is the most liquid asset class. Equities is the class where you've got all the control in your hands. If you don't do it, honestly, the government can't, neither can I, nor the government, nor Krishnan can help you. People on this call, if you don't put the bulk of your wealth in long-term equity investing, very little the government or anybody else in India can do for you.
So we had one more question coming in. The question is tax implications on PMS, mutual funds, and small case, any different?
It's identical. There's no tax arbitrage, folks. These are tax. The government does not give. These are all listed market equity plays. The short-term capital gains, i.e., less than 1 year, is 15%. Long-term, more than 1 year, is 10%. And whether you do mutual funds, PMS, or the small case style, the tax outcomes are identical.
One more question. NRIs can invest via NRI. Can they invest via NRI demat account?
Krishnan, Alok, would you know the answer to that?
Yeah, so there is one challenge for NRIs because on small case, they need to sign the investment advisor agreement with the help of Aadhaar OTP. So if they can get that Aadhaar OTP and sign the agreement, then they should be able to do.
I hope your question is answered, Mr. Joby. So we come back to that question by Mr. Basil Baby about ways to subscribe and the cost.
Alok, do you want to show the ways to subscribe and cost?
Yes, I'll quickly take you through it.
Go on, Alok.
1 second. Just 1 second.
Okay.
So there's one, somebody else has asked the same question, procedure for NRI to invest in PMS and small case. So maybe you can mention that when you're going through the process. Hello?
Yeah, sure. So my screen is visible, right?
Yep. Yeah.
Yes,
Okay.
yes.
Great. Okay, so let me start with the disclaimer. So investment in securities markets are subject to market risks. Read all the related documents carefully before investing. The figures which Krishnan presented or any stock name that we discussed are only for illustration purposes. They do not guarantee any future returns. Registration granted by SEBI, membership of BASL, and certification from National Institute of Securities Markets in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Now, let me come to the onboarding process. So this is a complete digital process. All you need is a trading and demat account with one of the listed brokers of small case. And just follow a few simple steps, which will probably take 5-10 minutes to get you invested. I'll go through these steps one by one for better understanding. So to start with, Dhanam's team will share 2 links with you all to choose from for the subscription. Now, one link will be for a fixed fee plan, which is 2,500 per quarter. And the second one will be the AUA based fee plan of 2.25% per annum. Now, the minimum investment amount here is around 2 lakhs. It's a little dynamic, it keeps on changing, but currently it's around 2 lakhs. So anybody who's looking to invest a larger amount, they can go in for the fixed fee plan. That will be cheaper for them. And anybody who's looking to stick to the lower ticket size, they can go in for the 2.25% per annum plan. So for example, on a 2 lakh investment, the 2.25 fee will come to around 4,500 per annum, which will be divided into monthly 30-day rolling periods, and they will be paying it on a monthly basis. Now, once you have clicked on the link of the choice of your fees, the current screen will appear, and you will start with by adding in your email address. Once you have entered the email address, again your fee plan will be visible on the screen. You will have to tick the checkbox against that fee plan and enter your KYC details like PAN number and date of birth. Once you enter these KYC details, you will click on continue, which will take you to the risk profiler. You will need to answer a few set of questions to ascertain your risk profile. And the system then matches your risk profile with the product's risk profile. In case your risk profile doesn't match to the product's risk profile, you still have the option to continue. You can click on continue with it anyway to proceed further. Next, you will have to select the broker. So there are 16 brokers who are listed on small case. All the prominent brokers are available like Zerodha, Motilal, HDFC, Angel Grow, etc. So wherever you have an account, so for example, if you have an account with Zerodha, click on Zerodha and enter your login credentials of your Zerodha account. As soon as you log into your Zerodha account, the system will ask you to read and sign the investment advisor agreement. We will recommend you go through the investment advisor agreement and then use the Aadhaar OTP to sign this agreement. For this, you will have to click on the checkbox of the terms and conditions, enter your Aadhaar number, click on send OTP, and then submit the OTP. As soon as you submit the OTP, agreement is signed and you will be prompted to make the fee payment. So you have 2 options to make the fee payment. Either you use the UPI option or the bank account option. And while making the fee payment, you will also have to set up the auto renewal mandate so that the future fees gets deducted automatically. As soon as you make the fee payment, the portfolio advice or the advice portfolio is visible on your screen. You'll be able to see all the companies which have been advised in this portfolio currently. You can confirm the order type. You can select one time or one time plus SIP and then continue to execute the order. There is a probability that you might not have a clear balance in your trading or demat account. In that case, it will prompt you to add funds to your demat and trading account. Once you have added the funds to the account, it will redirect you to the Invest Now page. And you can complete the execution here and your MeritorQ investment is live now. In case you face any queries related to execution, you can reach out to help@smallcase.com. In case you have product related queries, you can write to help.ia@marcellus.in. Yeah, so that is all from my end. If there are any queries related to this, I can propose as well. Back to you, Saurabh.
Thanks, Saurabh. Thank you. So the Dhanam team, hopefully that was clear. I think both on fees and hopefully that was clear on the investment process. It's a straightforward process. Your readers will create your readers will basically pull in an investment advisor, Marcellus in this instance, to suggest to them stocks for their demat account. So our job as an investment advisor will be to give them the stocks to buy and the weightages. But we are advisors here. It's your clients, it's your clients' demat account, and it's their money. We are merely advisors here, and there's no lock-in. If you don't like what we are doing, you can get rid of us that very minute.
Thank you, everyone. Thank you so much for attending this session. I hope there's nothing more from the Marcellus side.
Thank you. That's all. Thank you, Dhanam. Thank you for hosting us.
Thank you, Saurabh, Mr. Krishnan, and also Alok for this session. I hope each of you present and attending had a very informative session. And feel free to reach out to us or to them if you're interested in signing up. We will also be sending a follow-up mail in the coming days where we will send you the links. You can use it to sign up on Small Case. Thank you.
Thank you.
Thank you. Thank you.